What's going on, you guys? Welcome back to a brand new video. In this video, I want to share with you why you need to stop using smaller time frames. All right, you guys, so jumping right into the video, I want to discuss with you why it's so important for you as a trader to stop using these smaller time frames. If you're a day trader or if you trade these minute time frames, don't feel attacked. I'm not attacking you personally. If that method of trading does work for you, feel free to continue using it. Feel free to do whatever you feel like works. This is just from my personal experience, and that's all it is my opinion and my experience. So the first point I want to get into is that trading smaller time frames are filled with too much noise. As you start to build trading experience, that's very, very important, and it's very crucial for your trading plan. If there's too much noise in your trades, then you're not going to find clear analysis, you're not going to have a proper strategy, and as well as assessing your risk for the trade. If there's high wicks, a lot of volatility, there's a lot of candlesticks to be read, you won't understand what to filter out and what's actually important data that you could use for your trades. For example, I'm going to pop up on the screen my most recent trade for XEUUSD, which is my most recent analysis to date, and I'm also still inside of this gold trade. So as you guys can see, gold has been on a very consistent uptrend since mid-March. Gold has been following all of my technical analysis, following the level structure, breaking into new levels periodically, as well as following the trend. Now, without getting too technical, you can see with the naked eye that gold has been on a very bullish movement ever since mid-March, and we're currently in a zone of consolidation. The market is slowly starting to stabilize, and from that stabilization, we can slowly assess if the price is going to go bullish or bearish from the current price it's at. It's currently settled in the 1660 price point and the 1730 price point. It's been maintaining in that zone for the last. If we jump into the 15-minute time frame, it tells us a whole different story. On the screen right now, there's no clear signs of a trend, no clear signs of support and resistance. There's a lot of noise, a lot of candlesticks filling up the chart, not really telling us the direction of the trade. Is it bearish? Is it bullish? Is it following technicals? Honestly, we don't know looking at the 15-minute time frame. As of right now, there's just a bunch of consolidation with bullish and bearish movement, not really telling us any intended direction. Like I said, too many candles means too much noise for you to take the trade. Another reason you want to avoid those smaller time frames is because the mental stress that you put on yourself as a trader reading every single candlestick. Now, if you're currently assessing those smaller time frames, you probably understand already what I'm talking about. When you're looking at every single candlestick, trying to identify a perfect position, trying to assess your candlestick patterns, trying to find clear trends, important resistance, the smaller time frames can be very, very confusing. You get a lot of consolidation, you get a lot of unnecessary movement, and because of that unnecessary movement, you're not confident in any type of setup. Now, let's say you enter that trade, you're not confident in your setup, you're now second guessing the trade, you're not sure of the intended direction, you're scared you might lose money, causing you to back out of the trade in a loss. Like I said, a lot of mental stress, a lot goes on inside of these smaller time frames, making you more confused, not really understanding what's going on. When you jump to the larger time frames, it's a lot easier for you to assess every single candlestick because now there's less candlesticks and you get the bulk of what's happening in these smaller time frames in one big candle. Now, another little note I want for you guys to add, if you're always opening up your MetaTrader 4, if you're always looking at your chart trying to see what's going on, that's another telling sign you might lack a little bit of discipline when you're trading. Now, if you lack discipline, you're going to have poor trading habits, you're going to have bad trading psychology, which ultimately will result in you losing money inside the markets. Trading the larger time frames will also give you a lot more time to find safer positions, understand the movements of the candlesticks, and it'll take a lot more stress off you as a trader assessing these bigger time frames. Now, something else you need to put into perspective is you need to start thinking like these professional traders. The second you start to think like these professional traders, that's when you start to make smarter and more logical decisions, right? Do you think these professional traders are always assessing the 5-minute, 15-minute, the 30-minute? No, of course not. They're looking for those longer positions that they know are going to pay out on their accounts. And that's going to wrap it up for this week's video. If you guys learned something, please drop a like. It helps me out a lot. My name's Carlos. Take it easy.